Valuations, and we're live. Okay, good evening, everyone. Welcome to another edition of the Quarantine Sessions. These sessions are created in partnership with the Cairo Angels to give you all the insights and some information, some training aspects about different aspects related to building a startup. Today, we have a very special guest, Nader Ibrahim. He's going to talk about startup valuations, in particular, what is happening with the COVID crisis and how this will impact. Dr. Nader, thank you so much for joining us.
Thank you, Valentina. It is my honor to be part of this session today with you, and hopefully for the participants and to get more insights and more information about valuation, as it's one of the most important tools during the COVID-19 and all the crises now we are facing now. Let's start, and if we have any question, I will try to summarize all things and all the aspects. And anyway, I will leave my email if we have anyone has a question. Have a question tomorrow and after tomorrow. I will be happy to answer all questions about the valuation.
Perfect.
Okay.
Perfect. Thank you so much. There's Mohammed who's tuning in already saying hello. If you have questions, if you want to tell us where you're tuning in from or what are your doubts, please write them in the comments and we're going to be asking Dr. Nader. I want to start with a very sort of beginner question, right? When should an entrepreneur think about calculating the startup's valuation? When should they start estimating that?
Okay. Let's start with the valuation is the interest of the equity holders of the company. Mm-hmm. How to value our equity interest in this startup or any company all over the world, any company. That's why they should prepare or conduct a valuation model or valuation for at each round of investment, starting from pre-seed, seed round, or Series E, Series B, and so on. That's why the startups should conduct evaluation in order to value the company and the stakes offered for the investors, whether it's angel investors or venture capital, and so on. However, the startups also conduct evaluation to assess the business model and strategy for the company. The new trend in innovation is value-based management. How to assess the company based on business model and strategy and type. Even the companies who pivoting their finance or their business model or change their business model, they should conduct valuation. That's why the valuation based on the previous assumption and previous model. Whether to B2B and then we turned into B2C, for instance. That's why the number of customers is different. The target, the TAM is the market is totally different. The way of collection, the fees, and so on. That's why we are conducting a full valuation. In this case, at each round of finance, there's the first one. The second one is the second time is the business and the third one. The model or changing everything from a different perspective. That's why the value
I'm sorry to interrupt. 1 minute. I think there is a difficulty with some issues with the audio. We're going to try to fix it in the Zoom app.
Even the company
Let's see if it's improved a little bit now. There have been some issues with the internet these days.
Sorry.
Are we back? Can we try? Can we try? Can we try? I'm sorry, Dr. Nader. There have been some problems with the connection again.
I'm sorry also.
Yeah, we're getting messages from people about the sound quality. Let's try now with a different network and to resume our conversation about estimating valuations.
Sorry, again.
Can you hear me?
Yes. Sorry, it's lagging. For your voice is lagging, I think.
Okay. Let's see if we can. Can you hear me now? Can you hear me
yes.
Now,
this is fine now.
Okay. Okay. Good. Good. So let's resume. You were saying, when the founder should start estimating their valuation and how to do that.
Yes. When the first one at every level of any round of financing. As long as I'm trying to attract more investors, whether it's our angel investors, incubators, accelerators, and so on, and angel investors and venture capital and so on. That's why I will give them a stake for 10% or 15%. At what value? This is the most important thing. We have to conduct evaluation at every round of investments, including the company. The second thing is valuing the company to assess the management, the business of the company based on the value-based management. And I'm assessing the strategy of the company and the business model and whether the company's values is growing or still or going down or full or fail or something. The third time they should conduct evaluation when they are changing their business model or pivoting from their business model. As long as in the new parameters, there is a new parameters for the new challenging pivoting the market, whether the market changes or the audience and the market and target market and so on. That's why they conduct the evaluation at these three stages.
Right. Okay. And what are the methods to do that?
Sorry?
What are the methods to calculate that?
The methods there are different methods of conducting evaluation. But the most important and the most commonly used worldwide is the discounted cash flow. As long as this method is depending on the fundamentals of the company, how much the company can generate cash flow from the business. The greater the free cash flow the company can generate, this reflect healthy financial position of the company, that they are able in Homa to generate revenues higher than the expenses and the collection of the cash. That's why the company can use more cash to reinvest again and growing the company. Let me share with you all the presentation. You see this? This is your email, I think. So, I'm sorry.
No problem. No problem.
As you see, the discounted cash flow is depending on how much the company is generating in the future cash flows in using an expected rate of investment return. That's why the importance of the cash flow. The cash flow is the fuel of the startup. That's why it's better to generate cash flow from inside the company through their business. That's why this method is depending on business valuation. I'm valuing the business of the company. How much generation? This is the efficiency of the company to generate free cash flow. Type. What do you mean by free cash flow? The free cash flow is the operating cash flow of the company minus the investment, the capital expenditure needed for the coming period, and the working capital required of the company. يبقى if we have a free cash flow positive, يبقى this means that the companies can sustain and can grow because the company has an operating cash flow can cover all investments required, especially the capital investment needed for the coming period for the expansion, for instance, and the working capital requirements. That's why we have to generate or to conduct evaluation for the coming 3 to 5 years. Yet, the more the free cash flow, this is the reflect a healthy financial position of the company. But what if this cash flow is generated in the future? So we have to discount the future cash flows of the company to bring it to the present value of the future cash flows based on this equation or this formula. The cash flow of year one, this is the value of the company over 1 plus I. I is the discount rate, which is in this case in startups, which is all investors are equity investors, using the required rate of return of the investors. Sometimes, on all cases of the startups, the discount rate should be high. Reflecting the required rate of return of the investors should be high based on the risk taking. So the risk taken or the risk factors that reflect the investors is seeking for 25-30% discount rate, that they should discount the future cash flows of the company, as you see in this formula, over the period. Time. We are conducting the forecasting for the coming 3 years or 5 years. Will the company stop on it? Then we build the terminal value. This is the free cash flow, assuming the terminal value, the last free cash flow will grow at constant growth rate till infinity. Yeah, this is the most important thing, that the terminal value determines the most higher value of the company. As long as the terminal value, assuming the company maintain itself positive, or sometimes in first or second year negative, but it turn it into positive cash flow. And then the companies will grow at a constant growth rate for the future. Yeah, but that's why we have to bring them the present value of the future cash flows till now, or to bring it now, as long as the investors will they need to invest on the money of today. That's why we should bring the present value of the future cash flows. The most important thing in this, the importance of this method, that the companies or the startups should conduct all aspects. Let me show you some Excel sheet, very simple Excel sheet.
Yeah.
In this case, assuming the company is XYZ, this is the income statement, the forecasted income statement based on the sheets of revenue streams, and conducting the revenue streams for the coming period, the COGS, the cost of service, and the payroll as a part of the expenses, SG&A, selling, general, and admin expenses. Let's give us the income statement for the coming 3 years, assuming 2019 is the historical, and the forecasted is 2020, 2021, 2022. And then this is the balance sheet and the cash flow statement and the free cash flow. This is the operating profit, adding the depreciation, increase in working capital requirements, and the capital expenditure. Yet, the more or the greater the free cash flow in the future, this gives the confidence for the investors that in the future, the company's return will be high. In conducting the valuation, the first is, I'm trying to discount the the future cash flows of the company using the discount rate, assuming it's 30%. Nowadays it's 30% or 35%, as long as it's risky more than the existing companies, the higher companies. However, the existing companies such as General Electric and General Motors and so on, they also face major problems, and they have now high risk. And then we discount the future cash flows of the company. We bring the company's value using the discounted cash flow is 7 million now, based on the future cash flow. يبقى the most important thing ان احنا we use the terminal value. طيب, at sometimes with the venture capital funds or a startup valuation for investment in startups such as angel investors, sometimes use the terminal value is the exit value. How many times or how multiple I need for the investments after 3 or 5 years. I'm exiting after 5 years. Type, I need 10x on my investments, 5x, 7x, and so on. That's why, Bardo, we should consider to bring the present value of the future terminal value on this case. Yet sometimes we use both. However, there is uncertainty of the exit value will be. This is the requirements of the investors. Somehow they put higher expectations, and the companies fail also. Okay, but sometimes we saw a lot of failure stories all over the world. Yeah, but this is the most important thing, and that depending on the fundamentals of the company, based on building a revenue model for the coming period, cost, expenses, and expenses, and the marketing, and so on. That's why, this is the importance of this method. Right. Okay. Let me back again to presentation. The second things, or the second types of valuation is the multiple valuation, using multiples for the company with comparable transaction. Assuming my startup is an e-commerce platform. Type Souq was sold, or Amazon acquired Souq for 700 million US dollars. Assuming the revenues of Souq at that time is 100 million. Yeah, but this means that the comparable transaction is 7 times its sales or its revenues. Yep, my startup is e-commerce platform with their revenues of 10 million. Yeah, but that's my value. The valuation of my startup is 70 million. This is the comparable transaction, actual transaction. Fine. The second thing is comparable company. Using a comparable company such as Bardo, I'm in e-commerce. Yeah, I can bring the price to sales of Jumia, Souq, Amazon, and Jumia. That's why, and then I'm comparing my company to the type. However, unfortunately, in Homa, this is sometimes subjective, as long as in Homa there is no identical companies all over the world. It's guidelines for the valuation. We should prepare our revenue model as long as we are not identical. Alibaba is not the same like Amazon. Yeah. They are different in their business model. We cannot compare. Yeah, and this is for guidelines. And then as an e-commerce platform, I should consider, but this is will not be the main value of my startup.
Right. I have a small question right there in the middle. You're mentioning comparing valuations when they were at similar stages of development, right?
Yes, true.
What is a quick hack for entrepreneurs to find those valuations? Are there platforms that they can check?
Unfortunately, using comparable transactions, sometimes it's undisclosed amount or valuation, or unfortunately, the real data hard to come by. We cannot find the real value of most of the startup valuations. However, in the comparable companies with the listed companies such as Jumia, Souq, Amazon, Microsoft, Apple, and this is applicable as long as they have to disclose their financial statements based on they are listed in the stock markets. The stock exchange should be. So that's why it's the closed deals, unfortunately, there is no data. It's hard to find, unfortunately. This is the problem, unfortunately.
Yeah.
Type. The valuation, the venture capital valuation method, this is the third valuation technique. The terminal value, this is the valuation at exit, خلاص, over the post money valuation of the company, خلاص, equals the return on investment. طيب, يبقى the terminal value, assuming the post money valuation is unknown so far. طيب, we need to required rate of return is 20 times. Assuming 20 times. Type valuation at exit, we need the company to be 150 million, $100 million. كويس؟ يبقى that's why assuming type the terminal value is the earnings times the PE, the price earnings ratio. يبقى assuming the potential exit terminal value is 150. طيب the required rate of return of the investor is 20 times. طيب يبقى calculating the 150 over 20 يبقى the value of the company should be 7.5. Assuming the size of investment, this is the required funding by the company, is 3 million, يبقى the pre-money valuation is 7.5 minus 3 million, it equals 4.5 million. But sometimes there is a problem of determining, unfortunately, the potential exit, unfortunately. خلاص, the multiples. Sometimes there are unrealistic required rate of investments from the side of the investors. Sometimes are unrealistic. But we can use different methods of the company. Let's go back to the Excel model. طيب. Assuming here in احنا we use the multiple valuation at sales at 6 times and the net profit is 9 times times the value of the sales and the value of the net profit, يبقى this is the value. Based on that, we have two methods or two valuation or multiple valuation based on the sales and based on the profit. We give them weights. It's the best practice. No correct answer in this. We give weight for the sales 60%, for instance, and 40% for the net profit. Yet the value of the company is 6.2 million based on the multiple valuation. However, we conducted the valuation based on the discounted cash flow and based on the multiple valuation. Yeah, but that's why we have to make a weighted value for the company based on to give the DCF 70% weight and the multiple 30%. This is the best practice worldwide. No correct answer for this also. But the weighted average of the company is 6.7 million US dollars. خلاص يبقى this is why ان احنا we combine both methods as long as to there's some disadvantages in this or some mistakes in the multiple valuation and some exaggeration in the DCF, so we conducted a weighted value for those companies. Unfortunately, and sometimes with the companies in the idea stage or with the negative cash flow with no revenues, sometimes the companies used those methods based on the first year, starting from the first year of generating positive cash flow or generating revenue, assuming we'll generate revenue in 2022. That's why we discount over the third year and then fourth year and fifth year and so on. This is why as long as if we conduct the valuation right now, the companies will be negative equity. That is not applicable. Back to the presentation. I'm sorry for changing but the need to show the
very, very useful. And if you guys have questions, type them in the comments. We're going to be answering. We're looking at the comments. We're seeing you, so you can just type them there, and Nader is gonna answer.
اوكي طيب. يبقى sometimes برضه the methods the most يعني one of the يعني not commonly used somehow by the investors or VCs the scorecard. The scorecard إننا we are giving valuation factors for the company. The management and team giving them the highest weight. This is especially for the companies not generating revenues so far. يبقى the management, they have a qualified team with expertise, higher expertise, and so on. The size of the opportunity, the market. I'm going to tackle the market with 100 million people or 1 million. يبقى this is give them weight starting from 0 up to 25%. The product and service نفسها and the solution of this company is providing خلاص, and this is tackling a major problem خلاص. Such nowadays طبعا this is we can give weight, higher weight for the companies in the working in the field of medical field and e-commerce and the e-learning and so on. Give them more weights. The marketing and sales, the competition طبعا give them weight. The competition in the market, do they have competition, higher competition or smooth competition with or no direct competition? طيب, need for more financing after this round. We assume that the company now required 1 million. But after 6 months, they will need 2 or 3 million. This is we can give it a weight for factors. And some others, but any other factors we collect, the geographical area, some political issues and so on, that we give them a weight. This weights, unfortunately, the disadvantage of this method, it's somehow subjective. I like you as an entrepreneur, I will give you 30 out of 30% for the management. The size of the opportunity, I can assume blindly كده, this is a growth market and a huge market and so on. So that's why with no calculations, actual calculations, whether the company will generate revenues, will tackle this market, the size of the opportunity is 20%, 25%. Type, the market is huge. Do I have to gain market share or not? This is unfortunately the problem of using this method. However, depending on all these factors, there are a lot of other methodology less used or not commonly used in the real life. However, the basic thing for startup, they have to conduct a financial model for the coming year, regardless of using it in the valuation, using a discounted cash flow or not. They have to prepare or to submit for the accelerators or for the incubators or for the VCs or the angel investor. They have to provide or to submit a full financial plan for the coming period. That's why, based on this, we will value the company. Somehow the terminal value will increase the value based on the potential. There is a higher potential of the company in the coming period. This is the summary كده of the major financial or financial valuation models that can be used in the startup valuation. However, the same methods are used for the existing companies with the big companies, but the parameters is different. As long as in the building the revenue model, and I'm investors as an investor, I'm looking for exponential growth for the startups, as long as from the day one they don't have any revenue or any customer. They have 100 customers. This is the 100 times growth rate. However, the growth rate in the existing companies, the huge companies growing at 5%, 10%, 20%, I'm expecting higher exponential growth rate from the startup companies.
Right. Now, we were saying earlier today, right? COVID is having a very, very harsh impact on entrepreneurs and startups and businesses in general. How do you think this is affecting valuations, and how is it going to affect them in the near future?
Let's think that the COVID-19 pandemic is rapidly putting startups in a novel situation. It's new for all of us. Quite. A large number of entrepreneurs and startups, they are expecting that they have some negative impact on the company's operation and financial position. Even in the core business or the winners. If we split the startups now, the startup scene all over the world, there are some winners اللي هو using in the medical field, working in the medical field, the grocery, delivery, e-commerce, and some failures such as the tourism and some real estate, for instance, and so on, and some is neutral, but all they have a negative impact. However, the startups in the field of the medical or delivery of grocery, they were ready for this crisis? I think most of them all over the world was not. I think so. This is from the scene in Egypt. They were not expecting a large number of customers and large number of users right now, and they cannot fulfill the requirements of their customers. This is the main problem, and they need more funding. Failure will face problems in finding their problem, as I will not inject companies to pay salaries with no expected revenues. However, there are expectations that the valuation will go down in the coming period. However, the investors still will invest. خلاص؟ we agree that the investors will invest, still investing. But they will look aggressively on the due diligence, doing testing the opportunity, the right opportunity for their company, their investments. However, the VC by nature are aggressive. They might invest heavily. However, the corporate venture capital or the family offices may reducing their activities the coming period, as long as they are facing in the other business, their business is facing major problems. The expectations that in the winner companies, even a discount of 20% on the values, the common values around, or the prevailing values now. The failure or the zombies, as one of the mentors called the startup, the failure startup, it might face a 50% around. However, in both types, they will face a tougher terms and conditions in investment with the VCs will be tougher for the startups, as long as they need to make sure that the companies will growing and they can sustain for the coming future. However, the most important part, or the larger part of the investments, especially for the VCs, it will be for the existing investments already in their portfolios. To rebuild their position or to revamp their financial position and to push them not to fail. However, they will be look much deeper for the new startups. However, by nature, the VCs and the angel investors are by nature long-term investors. Their mandates is from 5 to 7 years. But they are expecting, even they can invest in tourism applications and tourism startups nowadays. They are planning for the coming future after the returning by the tourism and they open the air flights and so on. That's why, but I can invest in tourism in lower valuation, at very lower valuation. That's why they are also able to invest in this. I heard about the Airbnb. The investors of Airbnb, they invested in 2008 and 2009 after the financial crisis of 2008. They invested and then they boomed after the crisis in 2008 and 2009. That's why there is no limits for investment, even in the companies or startups they are expecting to fail. But I can watch and wait till the next 6 months or the end of this year to see whether you can sustain or not. And then you will be, I can invest again in your startup.
Right. We have a question from Ahmed Abdelaziz. He's saying, based on your presentation earlier, I could see that most objective methods of the ones you presented are discounted cash flow and multiple valuation, sales profit, and weighted valuation, DCF plus multiple valuation. Am I correct?
Yes. This is totally correct. This is the most, you spend more time in conducting the full your financial plan based on your business model and the expenses and so on. You spend a lot of time in conducting this financial plan. It will be a target for your team and your especially sales team and operations team to record this according to, based on the valuation, we recorded $6.2 million US. Based on to record this value, we have to record this revenues and this expenses. This will be target for the operations and the sales. That's why the fundamentals is very important. The VCs and the angel investors will be cautious for the coming period for your financial plan and financial model. They will discuss every and single number in your financial plans. However, the multiple valuation, it sometimes depend on the comparable transaction you are not, but however, it gives you a guidelines for the valuation.
Right. Ahmed Yusuf is asking, could you advise us how to survive or go ahead? He's working in the healthcare sector.
Right. Let's move forward and ask Ahmed. I think the first decision is to lay off the employees if you are facing a problem. However, I think this is not the right or the rational decision for right now. I think you have to keep the good team, the good calibers, and the second thing, you have, as long as into your medical field, you have to increase your spending in marketing. You have to attract more customers in order to generate more revenues and more cash flow. That's why, and you are trying, as long as that your companies is in the middle of the problem, the crisis. You have to invest more money in collecting money and attracting more customers, especially retention the old customers. The second thing is the rational spending. This is the most important part, is the rational spending. Spend on the more on your product, on your service, with no excuse in low quality for your service, and then you can reduce your expenses or your cost by changing the office location. Your rent is 10,000. Check for a co-working space to work from it. This is unnecessary spending. You can work remotely, as we are all work remotely now from our homes. No need for office now. You can reduce the 10,000 of your expenses. We have the rational spending for the main expenses that could not affect your quality or your presence in the market. And then start keeping developing and keeping adding new features and keeping trying to satisfy the old customers and retention for your customer and for adding new customers.
Right. Right. Ahmed again is asking, the valuation is depending on the revenues or the growth rate?
This is the question. Type profitability versus growth. Nowadays, that profitability by the book, the profitability is the sustainability all over the world. The profitability is sustainability. That's why in the pandemic problem or the crisis such as COVID-19 now, I'm not expecting higher growth, but I need the 10% growth with profit better than 100% growth with losses. As long as the losses, who will pay the expenses? The expenses will be more than the revenues. Who will pay? Keeping growth rate, small growth rate, you can serve better for your customers and then generate profit, and then the coming year after the crisis you can grow by 100 to 200%. The growth versus profitability, no, seek for profitability, even break even. At least not to make profit, but however you can sustain from your income. Otherwise, this will be a better. You will be in a better situation against the investors and VCs. Or you are seeking for our money to spend on salaries and rent and so on. That's why no. I need to grow after the crisis. This will give you a better chance for investment.
Right. Mohammed Damarawi saying, I think sustainability is growth. If you're not growing, you're shrinking. Adding to what you said.
Yes. I'm totally asking you to grow, but in a reasonable grow and realistic grow within a problem. We are in a crisis. Even companies in the field of the medical field or in the food delivery, they are facing major problems with the higher growth rates, many orders, but the cancellation, the fulfillment of the orders is not met. That's why they are still in problem. They will lose customers, by the way. But the orders is 200% growth. Thank you so much. But there is no income. There is high cancellation. Churn rate sometimes is very high churn rate. That's why we have to consider. We have to trade off between growth and profitability. Yes, I'm asking you to grow. But in the crisis, not the growth, small growth, level of growth with acceptable level of even break even.
Right. Ahmed Abdelaziz says, I believe that for startups with 1 or 2 years of operations, the valuation would be a bit based on expectations for the coming 3 to 5 years. Would my valuation line up with the investor's valuation? In other words, would they buy my valuation of my company or would mine clash with theirs?
Sorry? The last sentence?
Would my valuation line up with the investor's valuation or would my valuation clash with the investor's valuation?
According to their perspective and their ticket size, by the way, they are putting money at the higher valuation. Some of the deal breakers between the startups and the VCs is the exaggerating in value. Some startups are exaggerating in their value and having an unrealistic value. The investors, why should they pay $10 million US in such application? I can bring a new team and CTO and technical team and build from scratch a new company from scratch. That's why, and not exaggerate in nowadays, not exaggerate or don't have an unrealistic value. They have to put in the ground according. Accordingly, sometimes the valuation, based on the valuation, is assuming enough 5 million US dollars. I'm giving you, as you are my first investor or the seed round of investment, I will give you a 20% discount. The value is 4 million US dollars. خلاص, this is the common, the most commonly discounts for the value is around 20% or up to 25%. According and انت you are trying to attract them, خلاص, not to lose the investment momentum. That's why I'm giving you invest as long as you are the first round of my first round of investment. I'm giving you 25% or 20%. Is it acceptable for them? It's negotiable, by the way. يبقى the valuation of from your side and the valuation from their side is negotiable. However, if you are talking with the different VCs and they have different valuation, خلاص, but in the same round they have to invest at the same valuation. فusually we'll take the lowest valuation, خلاص, based on they can use the higher discount rate in the discount model, the discounted cash flow. And instead of 30%, we will discount at 40%. يبقى the value will go down. يبقى the most important thing is how desperate you are. If you are desperate to have the money of their money, I think you will accept anything. If you will sell, or if they tell you 1 million and you accepted, خلاص, this is the value of the company is 1 million now, خلاص. And this is a transaction, a real transaction happened actually.
Right, right. So last one, Ahmed Abdelaziz was asking if they were able to get the slides in the presentation at some point and as well as the Excel sheet. So the webinar will be available on our YouTube page, so you can always check out all the presentation once again. You can check it out there. And
right, I will check with Valentina and so on. Everything is possible. No, thank you so much. No problem.
Perfect, perfect. You can contact us as well. You can message us. You can email us. We're always here to support. So thank you so much, Dr. Nader. It was a very, very fruitful session. I think we've covered so much. It's a bit overwhelming. I for sure will be watching the video again.
So much. Thank you. I'm all yours. If you'd like to repeat it again and conducting an advanced or so, I'm ready. I'm really happy to be with you today. And thanks for Nadine and thanks Valentina. It was very nice for me to meet you. And see you in Cairo, inshallah, قريب. In the near future, inshallah.
Inshallah, very soon. Ramadan Kareem. And
Allah, thanks so much.
Thank you so much once again.
Thank you.
Thank you, everyone. Tune in tomorrow for another session. We're talking about going digital with Ahmed Omar. Thank you again.
Thank you.